Hello everybody, Luke Gromen, founder and president of FFTT, Forest for the Trees. Thank you all for joining me tonight here for another quick two things that grabbed my attention recently. Wanted to start off here, two things. First off, 2 of 3 treasury auctions last week, and they're all getting to be big auctions these days. 2 of 3 auctions this week, or last week, excuse me, were either the lowest or the second lowest bid to cover ratios since the depths, excuse me, since the depths of the great financial crisis. And I think it's an important data point, a critically important data point to watch for across markets. Another thing ties to this that we tweeted earlier today was that dollar hedging costs or FX basis swaps hit 18-year highs by the end of last week. And so what this means in plain English is that foreign buyers, the cost to hedge the currency of their dollar positions or their treasury holdings is rising meaningfully. Ironically, the more the dollar rises, the more prohibitively expensive it is for them to hedge the currency risk. The reason this is important is because, as we've noted before, and we've been talking about this in our research and in our tree rings product, the United States has to roll $7 to $8 trillion this year alone. It has another $1.3 trillion it needs to issue. That $7 to $8 trillion is not necessarily automatic to be rolled if hedging costs keep rising, which if FX hedge yields remain negative and the dollar keeps rising, the rising dollar reduces the incentive for foreign holders to roll $7 to $8 trillion. So what this means is that the pressure on the U.S. fiscal side and in markets in total will accelerate meaningfully with every tick higher that the dollar goes at a surprisingly rapid clip. And so, ironically, in the near term, this will drive the dollar up, this will drive treasury rates up, this will drive LIBOR up, this will squeeze dollar liquidity in a big way. It is probably not good for risk assets anywhere in the world. However, we continue to think that you know, the dollar, while it can rally higher, it is increasingly, as it rallies higher, becomes more and more of a picking up pennies in front of a steamroller trade, because at some point we're going to get a treasury auction that is going to be eye-opening in terms of how bad or how soft it is, and that is going to put the Fed in a corner. Push comes to shove, if the Fed decides to let a auction be really bad, to save or strengthen a fiat currency, a purely fiat currency, they'll be the first central bank to ever do so. And I'd be surprised if that's the case. The second thing I wanted to highlight is that for centuries, if not millennia, the global currency system has been based on effectively goods for goods trade, and the net of any net settled in a neutral reserve asset, whether that's gold, whether that's seashells, whatever. Often, of course, it has been gold, particularly in the last 300 years. For the last 47 years, the system has been a goods for U.S. IOUs trade. And the U.S. government, when you look at the crux of the trade war that we're talking about here with China, these tensions, the United States government wants to have its cake and eat it too. And in a multilateral world, it can't anymore. And by that I mean, U.S. government wants to both move towards good for goods trade, in other words, reduce our trade deficit, but it also wants to continue to maintain all the benefits of having the reserve currency, which is having deficits not matter. It can only choose one of those, and in practical terms, that means the U.S. can either have the reserve status with a gigantic defense budget and deficits not mattering, or it can have a shale and manufacturing sector that is relatively robust. And so that's the choice they're going to need to make. And so I'm going to stop there. There was a little more than 90 seconds. I apologize. And I'm going to open it up for questions. We have 2 questions first that people got to me on Twitter. The first is that why do I think the U.S. dollar in any sort of systemic reset would be a first among equals in terms of a reserve currency? And the answer to that is, I think in whatever comes next after the next crisis, however it's agreed to, you're going to move towards a system where you have a neutral reserve asset and a variety of different, we call it the basket of SDR currencies floating against that neutral reserve asset. Whether that's SDRs, whether that's gold in SDRs, who knows? Triffin's dilemma is ultimately having the reserve currency and having the reserve asset be the debt of the reserve currency issuer. That is a problem. That separating the reserve asset from any national currency would resolve. Why I think dollar is first among equals. We still have rule of law capacity that we can put in place given an appropriately valued currency. But ultimately, when you look at how that would impact having a neutral reserve currency or neutral reserve asset, with everything with the five big currencies floating against it, look, the U.S. is what, 40% of the SDR. We're 62 or 63% of global FX reserves, and we're 18 to 20% of GDP. It's a perfect example. We're punching above our weight. Our deficits are way bigger than anybody else's as a function of how the system used to work. The reserve asset would likely need to rise a lot in dollars. It might need to fall in yuan and yen. It might need to fall a little in euro. But you could work out a balance that way. So that's why I think the dollar will be first among equals. Second thing, someone else asked ahead of time, if the Fed is forced to step back in, and I do think we are much closer to that than most people think. Would that be good for gold and silver, and how much so? I do think it would probably be good for gold and silver. I question, how much and how long. I think ultimately the reason you want to own gold and silver, at least a little bit, and gold in particular, is gold's being moved back into the system as a reserve asset. It's not something that is talked about a lot in the Western media, but if you look at FX reserve balances since 2013 and maybe even since 2010, but certainly since 2013, gold has gained a lot of share from Treasury bonds as FX reserve asset in FX reserve asset bases, in Eurasia in particular. And so ultimately, I think that will drive a repricing higher. But again, that's a political decision, not an economic one, and not a market-driven one per se. Real quick before I jump into some questions on the screen, quick reminder, if you want to see what we're up to, FFTT-LLC.com. One thing we are up to this week, we do have our year-end wrap-up. I was working on the slide deck today. It's 60 slides, 55, 60 slides we're going to go through, talk about. It's on Crowdcast, so we'll be taking questions, Q&A, open Q&A for 2 hours plus. The presentation will probably take me about 30, 40 minutes to run through, and then we'll leave it open. And there's a limited number of seats, so go check it out, FFTT-LLC.com. Hope to see you on that. And let's see here. What do I define? I'm going to jump to questions here. What do I define as China's economic model? I think China has... I think they are communist at the top. I think they're capitalist at the bottom. I think they are a centrally planned industrial economy looking to maximize employment and political stability as opposed to profits per se. And I think that makes it challenging, particularly given our model at times. And I've certainly tweeted a couple things about this. There was a tweet, if you didn't see it earlier this week, about what Jeff Immelt, former CEO of GE, had to say, and just how difficult it is to compete against a centrally planned industrial production model. There's no industrial model, is what he was complaining about. The second question, how is the LIBOR OIS spread a show of liquidity? Off the top of my head here, hold on. Your LIBOR OIS is going to be basically a measure of the tightness of dollar liquidity in the euro dollar market. Call it the offshore dollar market, if you will. And so as those dollars get more scarce for whatever reason, LIBOR OIS should rise. Marcus, let's see. How much of that $7 to $8 trillion roll do I think the public can cover? I think that is a great question. I think it's a partial question, and so I'm going to add to that. How much do we think the public can roll? I think they can roll all of it. To me, the key question, or the follow-on, is probably the better way to put that. How much of that 7 to 8 trillion can the U.S. public roll with equity markets valued where they are? And that is not a lot. And that is the whole point of our trilemma when we talk about this U.S. trilemma, where the Fed can, the U.S. government, they can have a rising dollar, they can have rising rates, they can have rising stocks, but only two of those three. If the U.S., the problem with the rising dollar in an environment where FX hedge treasury yields are negative, and they get more negative with every tick higher of the dollar, as long as banks aren't growing their FX swap books, the U.S. government is getting choked out. And the U.S. government's going to borrow the money. They're going to get what they need. The problem, of course, is if they have to, and we saw this in October, FX hedge yields went negative right at the end of September and stayed negative and have remained negative. We saw what happened in October. The worst sell-off since February of 2009 wasn't an accident. You're talking about the critical plumbing of all markets. The problem is this is very, very bad for risk assets. And the United States economy, versus anyone else in the world, is uniquely levered to all rising risk assets. We are very much financialized. If you look at relative amounts, and we're going to go over some of this in our year-end review on Tuesday, but if you look at how important rising equity markets are to U.S. tax receipts, to U.S. home purchases, to U.S. car purchases, the U.S. public can fund that 7 to 8 trillion, but you're almost like putting fingers in a dam. They can block the dam of rolling over the 7 to 8 trillion, but if equity markets fall 10% in a month, like they did in October, you're opening up a new hole in the dam. In other words, your tax receipts, your consumption are going to start to deteriorate. You're going to move closer to a recession in the U.S., and so that it makes it tricky. Let's see, Austin, with the U.S. deficit spend increasing inflation, isn't the Fed multiplying it with QT and hikes? The deficit spend is, I think it could increase inflation over time. I think what it really is doing in the near term is pressuring, it's drawing dollar liquidity out of markets. You're seeing the Fed obviously add to that, like you said, with hikes and QT. It's putting a lot of upward pressure on the dollar. You've seen it in certain highly levered or the worst emerging markets. You're starting to see it filter into the U.S. economy. Housing is getting worse at an accelerating rate. Obviously, we gave away pretty much all of our year-to-date performance in equity markets last month. To me, you're starting, those are usually the signs where the Fed has to maybe back off. Let's see. Oh, you're welcome, Brad. Any other questions here? Yeah, if you want to sign up for the FFTT end of the year wrap up, it's there on the side as we speak. And let me see. Any other questions? If you have any other questions, let me know. Otherwise, I'm going to check out here in a couple of minutes. All right, guys. Well, I'm going to check out. Hopefully you have a great week. Good luck this week. And like I said, check us out if you will, FFTT-LLC.com. Looking forward to hopefully spending a lot of time with you on Tuesday afternoon. Details on our website. Thanks, guys. Have a great night.